95.9%. I mean, wow, that is a massive, jaw-dropping year-to-date rally, and it's the exact number staring us in the face today. NetApp is absolutely tearing up the charts right now, really positioning itself as an undeniable powerhouse in the AI storage space. But, with the stock sitting at this premium $207 price tag, we have to stop and ask a serious question. Is this a world-class franchise that's actually worth every single penny? Or are we looking at a classic value trap where all the good news is just already priced in? Welcome to The Explainer, everyone. To figure this out, we aren't just going to skim through some basic surface-level metrics. No way. We are running this stock through what we call the ultimate valuation gauntlet. We're going to strip away all the market noise, bypass the hype, and zero in on the true intrinsic value of the underlying business. We'll be looking at the raw math, the hidden narratives, and we'll even put it through the exact frameworks used by the absolute best investors in history. Here is our quick game plan for the gauntlet today. First, we'll look at the baseline stats. Then, crunching the 5 models, uncovering the hidden red and green flags, running the legendary investor test, and finally, getting to our final verdict. Let's jump right in. Step 1. The valuation gauntlet begins. Okay, let's look at the starting stats locked in as of August 14th, 2026. NetApp is sitting at a stock price of $207.08, which gives it a pretty hefty market cap of roughly $40.6 billion. Over the trailing 12 months, they've pulled in nearly $7 billion in revenue. But honestly, the real tension here lies in this crazy contrast between the price and the quality. You've got a trailing PE ratio of 32.5, paired with an absolutely incredible return on invested capital of 19.4%. Now that PE, that is undeniably a premium price tag. But an ROIC near 20%, that's a huge sign of exceptional business quality and capital efficiency. So the stage is perfectly set here, high price versus high quality. Moving right along to step 2, crunching the 5 models. To see exactly how that tension resolves mathematically, we synthesized a massive dataset of 21 different valuation models and basically grouped them into 5 distinct buckets. Group A, the cash flow models. They absolutely love NetApp's massive $2.5 billion in unlevered free cash flow. That points to a really robust upside, up to $240. Group B, dividend and income models. Well, they're kind of a mixed bag. They get dragged down quite a bit because aggressive share buybacks have artificially depressed the book value. Group C, peer multiples, those cluster right around $160 to $245. But Group D, the asset and book value models, oh man, they absolutely punish the stock, dropping the valuation as low as $10 in a fire sale scenario. Why? Because this is an asset-light tech business built on intangibles, not some hard physical factory. Finally, Group E. When we factor in advanced AI, real options, and massive cloud partnerships, it pushes our absolute highest potential upside to $270. So what does this all mean when you put it together? Well, when you average out all 21 models, the blended intrinsic value lands between $155 and $220 per share. And since the current price of $207 is clustering right near the very top of that range, the math is basically telling us that NetApp is fully valued, maybe even slightly overvalued right now. It's trading at roughly a 5 to 10% premium to the midpoint of its true intrinsic value. So long story short, this is very much a quality at a premium price situation. It's definitely not a deep value bargain. All right, part 3, hidden red and green flags. Now math only tells half the story, right? Let's peel back the media narratives for a second, starting with some deep red flags that usually get ignored. Most glaringly, the price-to-book ratio is dangerously inflated at 30 times. I mean, Ben Graham might literally roll over in his grave at a number like that. Plus, they have $2.77 billion tied up in goodwill, which is basically an intangible premium they paid over fair value for past acquisitions. If they ever have to write that down, it is going to leave a serious mark. Combine that balance sheet bloat with a 10K warning about structural supply chain inflation, slowing 5.3% revenue growth, a heavy reliance on third-party clouds, an elevated 23% tax rate, and some recent massive insider selling, like the president unloading nearly $7.7 million in shares. Put it all together, and you've got some serious headwinds threatening that premium price tag. But hold on, don't count them out just yet. The green flags are honestly just as intense. First off, NetApp is an absolute cash fortress. Free cash flows surged an incredible 39.7% to almost $1.9 billion, completely reversing prior declines. And their $2.74 billion in operating cash flow, that covers their dividends 13 times over. Throw in a pristine balance sheet holding a net cash position of $851 million, meaning, yeah, they have more cash than debt, a low 31.5% payout ratio that leaves massive room for growth, and of course that exceptional 19.4% ROIC. The fundamentals are just rock solid. When you factor in the massively accelerating demand for AI storage infrastructure across AWS, Azure, and Google Cloud, it is really no wonder the stock broke out to near 52-week highs. Which brings us to step 4, the legendary investor test. Let's see what happens when we put NetApp in front of a judges panel made up of the absolute best investors in history. How do they weigh this premium price against the company's growth? Well, Ben Graham, the father of value investing, demands tangible, hard assets. Because NetApp relies so heavily on software and intangibles, his calculated target, the Graham number, is just $31. So that's a hard fail from Graham. Peter Lynch looks at the PEG ratio to make sure you aren't overpaying for growth. At 3.7, which is well above his strict limit of 1, Lynch says paying 32 times earnings is just way too high for 8 to 10% growth. Another fail. Finally, Warren Buffett. Now, Buffett looks for quality at a fair price, so he absolutely loves the pristine balance sheet and that high ROIC. But with an owner's earnings yield of just 4.1%, which barely beats a basic high-yield savings account right now, even Buffett would stamp this with a weight. He'd likely look for a pullback closer to the $160 or $170 range before actually taking a swing. And finally, Section 5, the final verdict, moat versus price. So 3 legendary frameworks all advise caution right now, but we really have to ask, does this underlying business justify defying gravity? Actually, NetApp possesses what we'd call a wide economic moat, and it's built on 3 really powerful pillars. First, intangible assets. We're talking about their proprietary NTAP storage software, over 2,700 patents, and literally decades of enterprise trust. Second, immense switching costs. Think about it. Enterprise companies do not easily migrate petabytes of mission-critical data to competing platforms. Once you're in their ecosystem, you're basically locked in. And third, network effects. As giant hyperscalers like AWS and Google Cloud deeply integrate NetApp software into their own platforms, the whole ecosystem just becomes incredibly valuable and super sticky. So this moat isn't just wide. Thanks to the AI boom, it is actually expanding. Which brings us to the ultimate showdown of this entire explainer. On the left side, you have undeniable quality. You've got that wide, expanding moat, a pristine net cash balance sheet, and a truly world-class franchise generating exceptional capital returns. But on the right side, you have the price. It's trading near a 52-week high at 32 times earnings, which means the market has pretty much already fully priced in all the AI and hybrid cloud hype. And honestly, this valuation leaves absolutely zero room for error if things like supply chain inflation start biting, or if those big insider sales turn out to be an early warning sign. So it really all boils down to this. Is this a classic wide moat at a premium price scenario that is completely worth paying up for right now? Or is it a phenomenal growth story where the valuation has simply gotten way too far ahead of the actual fundamentals? The quality screams buy, but the price is definitely whispering wait. So which side are you on? I want you to run the numbers, do your own homework, and let me know down in the comments exactly where you stand on NetApp. Be sure to hit that like button if you found this helpful. Thanks so much for joining me on this explainer, and I will see you in the next one.